This is Paris Hoover, your Patton University online course instructor for this semester, Unit 4, Introduction. Economic cycles and conditions influence the stock market and the prices of individual shares traded on the market. While most businesses find it easier to generate profits during prosperous economic times, certain industries are more sensitive than others to changes in income levels and other economic factors. Industries that are fairly insensitive to economic fluctuations tend to have low betas compared with industries that are more cyclical and sensitive to economic changes. Many macroeconomic factors influence investor behavior, including supply and demand, inflation, and interest rates. Due to the effects of interest, a dollar today is not the same as a dollar tomorrow. Discount models allow financial analysts to use the time value of money to estimate the present value of future cash flows. The assumption of future interest rates is an inherent risk in the estimation of present value. Investors and financial analysts often rely on the general purpose financial statements prepared by management and audited by independent accountants. The Securities and Exchange Commission requires all companies publicly traded in the U.S. to file these statements annually, along with supplemental disclosures. The balance sheet presents the company's assets, liabilities, and shareholders' equity as of the end of the company's fiscal year. The balance sheet is a great tool for assessing short-term liquidity and long-term solvency. The profit and loss statement or income statement shows the company's accumulated revenues, expenses, and net income for the fiscal year. The income statement is an invaluable tool for assessing profitability. The cash flow statement shows the company's cash receipts and payments during the year and classifies them as operating, investing, or financing activities. The cash flow statement is very useful in assessing a company's quality of earnings. Ratio analysts and technical analysts are helpful in evaluating performance. The general purpose financial statements allow investors and analysts to evaluate trends and relationships between accounts using ratio analysts. Ratios are used to assess various areas such as profitability, liquidity, and solvency, and market performance. Additionally, ratios facilitate comparisons between multiple companies. Technical analysts evaluates trends and makes future projections based on internal stock market information, patterns, and behavioral theories. In this unit, you will explore the topics above through your textbook, articles, and supplemental readings and videos. Learning objectives. 1. Explain the relationship between economic cycles and stock market cycles. 2. Describe the functions of general purpose accounting and financial statements. 3. Analyze investments using financial ratios and internal stock market information. Please continue to Objective 1. Chapter 18, The Economic Environment, pages 393 to 402. The difficulties of investment analysts are summarized by Kogan 2006. The most obvious problem is the sheer amount of information that needs to be analyzed. When deciding to buy a particular share, investors need to assess the probity of the management, the appeal of the group's products, the threat from competitors in the sector of the economic conditions before even beginning to calculate the correct value of the shares, using a host of different measures. Not only do they need to understand conditions now, but predict how they will develop over the next 5 years or so. But even a very well-informed investor can struggle. That is because predicting financial markets is not like predicting the weather, an area where over the years short-term forecasting has improved because of better collection of data and sophisticated computer models. The key is that the weather does not change because of our forecasts, but a stock market is made up of humans interacting. Their perceptions change the conditions. In the current text, the discussion of investment analysts begins with the economic environment. Business cycles and stock markets. There are periodic fluctuations in the economic activity. Economies move through cycles of expansion and recession. Fluctuations in the level of economic activity are accompanied by fluctuations in corporate profits, interest rates, inflation rates, and other economic variables. Stock market prices also appear to have cycles, and those cycles are thought to be related to the cycles of the economy. If there is some regularity to business cycle, and if stock market cycles are related to the business cycle, forecasting business cycles could be used as a means of forecasting stock market movements. It should be made clear that the present discussion is concerned with fluctuations in the economy rather than the long-term growth of the economy. The long-term growth could be seen as providing a trend, and fluctuations as deviations around that trend. Sometimes the economy will be above the long-term trend and sometimes below it. Somewhat surprisingly strong long-term economic growth does not appear to be associated with strong long-term stock market performance. For example, Ritter investigated 16 countries over the 1900 to 2002 period and found a negative relationship between national income growth per head and stock market returns. However, this has no bearing on the relationship between stock market cycles and economic cycles, which is the concern of the present discussion. Share prices depend upon prospective profits and the dividends paid out of those profits. An important determinant of profitability of a company is the profitability of the industry to which it belongs. In turn, the profitability of the industry is strongly affected by the state of the economy. It is easier for a firm to be profitable when the economy is strong. And expenditure on goods and services is growing rapidly than when growth is weak. Fluctuations in stock markets will be affected by fluctuations in economic activity. Stock market cycles are related to economic cycles. However, industries are affected to differing extents. Some industries, such as food and pharmaceuticals, barely have cycles since they produce necessities that are little influenced by consumer incomes. Other industries, such as consumer durables and capital goods, are heavily affected by business cycles. Industries that are relatively unaffected by economic fluctuations are referred to as defensive in stock market terms. The shares tend to have low betas. Industries that are heavily affected by business cycles are referred to as cyclical. The shares have high betas. One factor that affects sensitivity to the business cycle is the influence of economic activity on sales. In some industries, consumers cannot easily reduce or delay purchases when actual or prospective income falls. Examples are food, pharmaceuticals, and water. In other industries, reduction or delay is easier. For example, the replacement of a car could be delayed until income prospects improve. Two other significant factors that affect sensitivity to business cycles are operational and financial leverage. Operational leverage is the extent to which the company has fixed costs. Fixed costs cannot be reduced when demand for a firm's products falls. Since costs cannot be reduced in line with revenues, profits fall more than proportionately to a decline in sales. This tendency is strengthened if the firm has financial leverage. Financial leverage is the use of borrowing for obtaining finance. Interest on debt must be paid irrespective of the level of sales. Page 395. Suppose a firm has fixed costs of £2 million per year, sells its products at £5 each, and incurs variable costs at £1 per unit of output. Sales of 1 million units provide a profit of £2 million. Sales of 0.5 million profit 0.5 million provides zero profit. A 50% fall in sales completely removes the profit. Suppose that the firm also has debt financing costs of £1 million per year. Sales of 1 million units provide a profit of 1 million. A fall in sales to 0.75 million would eliminate profits. A 25% fall in sales completely removes the profit. Arguably, the first stage in investment analysts is to forecast movements in the economy as a whole. This will affect both the extent of one's investment in shares and particular shares chosen. However, forecasts need to be not only accurate, but also early. An accurate forecast, which is made after other analysts have reached the same conclusion and acted upon it, is unlikely to lead to profits. The trades of the early investors would tend to move prices so as to remove profit opportunities for those that act later. Forecasts may suggest share price increases would provide profits for those who buy before prices rise, but the purchases would push up prices and thereby remove further profit opportunities. Investors who are late with their investment decisions will tend to miss opportunities to make profits. DiStefano found that stock markets rose during the early stages of economic expansion, but that the stock prices rises fell towards zero at the expansionary phase of the business cycle. As the expansionary phase of the business cycle approached its end, stock markets cease to rise while the economy is still growing. The stock market peaks before the economy peaks. During the early stages of economic contraction, the stock market tends to fall, but in the later stages of the contraction, stock markets rise strongly. The stock market rises while the economy is still contracting, so the stock market reaches its lowest point before the economy does. As a crude approximation, it might be said that stock markets rise when the rate of economic growth is rising, and stock markets fall when the rate of economic growth falls. DiStefano suggested that changes in the expectations about future company profits largely explained the stock market cycle. Moore and Colletti have established an average sequence of business cycle and financial market leads and lags in the United States for the period 1920 through 1982 as follows. Siegel has examined U.S. data for the period 1802 to 1997. He too has found a tendency for stock market turning points to precede turning points in the economic activity. His analysis suggests an average lag between stock market peaks and peaks in the economic activity of 5.6 months, with a standard deviation of 4.4 months. However, particularly since 1945, there have been a number of stock market falls that were not followed by economic downturns. He found that average lag between stock markets, TROs in the economic activity was 5.1 months with a standard deviation of 1.3 months. Please continue reading to page 402. Chapter 20, Company Accounts and Economic Value Added. Page 426 to page 437. Company accounts are important for analyzing investments because they provide information about the amount, sources of profit. Items in the accounts also provide the data for ratio analysis. The accounts comprise the balance sheet, the profit and loss account, and the cash flow statement. The balance sheet. Table 20.1 shows the balance sheet for a hypothetical company. The balance sheet shows the financial position at a point in time and is alternatively known as the position statement. The balance sheet could be looked upon as an accounting equation. The more permanent assets are termed fixed assets, while the less permanent are referred to as current assets. Intangible assets include items such as patents and goodwill. Goodwill arises from acquiring another company and paying more for it than the value of its assets. Generally, goodwill can be looked upon as the difference between the book value and the market value of a company. Tangible fixed assets include land, buildings, machinery, equipment, and vehicles. The values of tangible fixed assets are stated at their net book value. The net book value of an item is its original cost minus the estimate of the extent to which it has depreciated in the value with use and time. Current assets are less permanent items, typically having prospective lives of less than a year. Take creditors and bank overdrafts. Trade creditors and bank overdrafts, where the debt is to be settled within 1 year, are subtracted from the current assets to give the net current assets figure. Net current assets are alternatively known as working capital. The sum described as shareholders' funds is the amount that balances the accounts. The money allocated to the category of shareholders' funds is the sum that equates sources of funds with uses of funds. It could be looked upon as the difference between what the company owns and what it owes. Shareholders' funds are alternatively referred to as the book value of a company. This is not necessarily what the company is worth to the shareholders. The book value is based on generally accepted accounting principles. One of those principles is that the assets are usually valued at their historic cost. From the historic cost sum is deducted to reflect the depreciation arising from use and the passage of time. In the case of debtors, a provision may be made for bad debts, alternatively known as non-performing debts. The value of investors' shareholding is determined by the market value of shares and is equal to the number of shares issued times the share price. This value is alternatively known as the market capitalization of a company. The value of shareholders' funds that appears in the accounts is not the same as the value of the shareholdings as determined by the stock market. The ratio between the market value and the book value is known as market to book ratio or price book value ratio. In the present example, if the share price were 200p and there were 150 million shares in issue, the market value of shareholders' investments would be 300 million pounds. This implies a market-to-book ratio of 300 over 156 equals 1.92. The difference between the market and book values might be looked upon as value added by the management of the company. The profit and loss account. The profit and loss account is alternatively referred to as the income statement. It indicates how well the company has performed over a period of time, typically a year. Table 20.2 shows a hypothetical profit and loss account. The profit and loss account shows the sales income minus the cost of trading. The sum available for distribution to shareholders is the profit after tax. Table 20.2 can be seen that profit after tax is 28 million pounds, of which 14 million pounds is paid to shareholders as dividends and 14 million pounds is retained for investment in the business. Another useful value is the operating profit, alternatively known as earnings before interest and taxes. Page 429. Earnings before interest, taxes, depreciation, and amortization is calculated by adding back depreciation and amortization to EBIT. or are costs that do not involve immediate cash outlays. EBITDA could be looked upon as the amount of cash created by the company. Look to the following example. One justification for the use of EBITDA is that depreciation and amortization expenses are not cash flows, and they represent the allocations of historic costs rather than expectations of future capital expenditure. In consequence, they may not be particularly useful for assessing the ongoing profitability of a company. The current cost of acquiring fixed assets is of greater relevance for this purpose. Another justification for the use of EBITDA is that it indicates a company's flexibility to respond to changing circumstances. Since depreciation and amortization are not cash flows, EBITDA is a better measure than operating profit of the cash flow available for new investment. An alternative to EBITDA is in this context is operating cash flow. Earnings per share are derived from the profit and loss account. Look to the example below. The EPS can be influenced by exceptional and extraordinary items that impact on profits temporarily. For example, the sale of a building will add to profits in the year, but would not be repeated, and hence that part of the profit does not arise from ongoing business. Investment analysts will often adjust the EPS figure in order to remove the effects of exceptional and extraordinary items. This normalized EPS is referred to as headline EPS. The cash flow statement. The third financial statement in a published set of company accounts is the cash flow statement. This statement shows sources of cash and how the cash is being used. Table 20.3 shows a hypothetical cash flow statement for a period. The uses of funds are shown in brackets. The item financing refers to additional finance, for example, borrowing more money. The item servicing of finance refers to repaying debt and paying interest on debt. The uses of funds are alternatively known as application of funds. It can be seen from table 20.3 that the largest application of funds was on capital expenditure. Cash flow statements can be seen as dealing with three types of activity: operating activities, investing activities, and financing activities. Operating activities provide sales revenue and incur costs of production. Investing activities include purchases and sales of plant, property, and financial assets. Financing activity refers to issuing or redeeming shares and debt and the payment of dividends. Profits and losses from operating activities must be matched by offsetting net flows from the combination of investing and financing activities. Analysts of accounts. Accounts may be subjected to cross-section analysts and time series analysts. One form of cross-section analysis entails common size statements. In order to facilitate comparison between companies of differing sizes, balance sheet items may be expressed as percentages of net assets or total capital employed. Common size profit and loss accounts could express the components as percentages of turnover. Financial ratios can also be used for cross-section analysts. That is for comparing firms. Time series analysts may use the techniques of trend statements, ratio analysts, and variability analysts. Trend statements can be used for components of profit and loss accounts. A base date is chosen and the component of the accounts is given a base value of 100. Subsequent years' values are the expressed relative to the base value. A rise of 10% leads to a value of 110 being recorded. The results over a number of years are examined for many patterns or trends. Financial ratios can be subjected to time series analysis in order to identify any trends. Variability analysis aims to measure the dispersion of financial ratios and trend statement values over time. One approach might be to subtract the lowest observed value from the highest and divide the result by the average. Another approach would entail the division of the standard deviation of observed values by the average value. A number of changes over time can render time series analysis difficult. Changes in accounting standards, accounting policies, and accounting practices over time can make the interpretation of apparent patterns difficult. Changes in the composition of a firm's business over time can also pose problems for the interpretation of a time series. A particular source of change that creates problems of interpretation is price change. In other words, inflation. The inflation problem arises because most items in accounts are valued at historic costs, which are the prices originally paid. However, historic costs are likely to differ from current prices. As a result, historic cost accounting can cause published accounts to be misleading. A highly simplified version can illustrate this. Suppose that a firm buys 50 units of raw material each year and sells 50 units of finished output. Further, suppose that the inflation is running at 100% PA. The simplified profit and loss account for a year in which the raw material costs £2 per unit and the output sells at £3 per unit might look like that of table 20.4. Please continue reading to page 437. Chapter 21, Ratio Analysis, page 438 to 453. An investment analyst needs to combine all the information provided by ratios and accounts. This may involve a search for trends in these financial indicators together with comparisons with other companies. A thorough analysis of a company would go beyond the ratios and accounts, but this financial data provides an essential component for an analyst of the prospects of a company from the perspective of an investor. Price-earnings ratio provide a means of ascertaining the appropriate price of a stock. The price-earnings ratio is the ratio of a share price to the earnings per share. This can be expressed by equation 1 below. PE is the price-earnings ratio, P is current share price, and EPS is the earnings per share. The price-earnings ratio can be either backward-looking or forward-looking. In the backward-looking version, EPS could be interpreted as the most recent earnings per share. In the forward-looking version, EPS is an estimate of earnings per share during the next period. Published price-earning ratios are normally backward-looking. For the purposes of investment analysts, it may be necessary to have a forward-looking ratio. Alternatively, the past earnings per share could be used in conjunction with a justified price-earnings ratio relating to the present. The justified price-earnings ratio would be the ratio that the investment analyst believes should prevail in the present. If this justified ratio differs from the published ratio, it follows that the fair price of the share differs from the actual price. The fair price is the price that the investment analyst believes is justified by the current information. According to a survey of U.S. market professionals carried out by Dukes, the use of price-earning ratios for stock price valuation is widespread. Forward-looking versions are the most popular, but many use current ratios and past earnings. Sometimes the past earnings are averages from a number of previous years. Such trailing earnings averages should be based on figures up to 10 years into the past. Block also found a tendency for stock analysts to make considerable use of multiples, such as price-earnings ratios. and found that multiples were more used than discounted cash flow techniques. However, Glom and Friedrich found discounted cash flow to be more popular and that multiples tended to be used as checks to ascertain that the cash flow results were broadly consistent with the multiples. Glom and Friedrich found that the relative popularity of valuation techniques changed over time and that the favored technique tended to be one that gave price estimates close to observed current prices. Estimation of forward-looking price-earning ratios and the simultaneous forecast of earnings per share for corresponding future period allows for the estimation of fair price for the share. This is shown by equation 2 below. Multiplication of the price-earnings ratio by the earnings per share provides an estimate of the fair price of the share. The fair price of the share is the price that the analyst believes that it should be. The fair price differs from the actual price, and there may be a perceived profit opportunity from trading in the share. The use of equation 2 requires that PE is estimated separately from EPS. The estimation of PE can be carried out in at least 4 distinct ways. First, an average of the past price-earning ratios for the company can be used. Second, an average of price-earning ratios for similar firms can be used. The similarity may be based upon sector. For example, the appropriate price-earnings ratio for a firm in an airline sector could be estimated from other companies in the same sector. A third approach is based on the Gordon growth model. The Gordon growth model can be written as shown in equation 3 below. P represents the fair price of the share, D is the expected next dividend, R is the required rate of return, and G is the expected growth rate of dividends. Dividing both sides of the equation 3 by EPS gives you equation 4 below. P over EPS is the price-earnings ratio. The term D over EPS is the dividend payout rate. That is the proportion of earnings paid as dividends to shareholders. From equation 4, it can be seen that the price-earnings ratio rises with increases in the dividend payout rate and the expected growth rate of dividends. However, it should be noted that these two variables are not independent. A higher dividend payout rate involves lower reinvestment in profits and hence might be expected to reduce the growth rate. Equation 4 also shows that the price-earnings ratio is inversely related to the required rate of return. This implies that a rise in interest rates or an increase in the perceived riskiness of the share would cause a fall in the price-earnings ratio. Suppose that the dividend payout rate is 0.5, the required rate of return is 12% PA, and the expected growth rate of dividends is 2% PA. Then putting these figures into equation 4 gives the figure below. If the expected next period earnings share are £3, use of equation 2 gives the formula below. The fair price of the share is £15. If the market price is below £15, this stock should be considered for purchase. Regression analysis constitutes a fourth means of estimating the price-earnings ratio. Regression analysis is a technique for ascertaining the statistical relationship between one variable and one or more other variables. Equation 5 illustrates a hypothetical example of the result of a regression analysis. This hypothetical regression equation estimates the price-earnings ratio to be equal to 3 plus twice the growth rate of company earnings plus half the dividend payout rate. Putting forecasts of the growth rate of earnings and the dividend payout rate into equation 5 yields a number which the estimated price, which is the estimated price earnings ratio. Whitbeck and Kizer use an example of 135 U.S. stocks and produce the following regression equation. Whitbeck and Kizer claimed that the equation was useful for selecting stocks. Malkiel and Cragg regress the price-earnings ratio on analysts' forecasts of earnings growth rates, estimates of normal earnings, forecasts of future earnings, and expectations of the future variability of earnings. They concluded that such regression equations were not useful for selecting stocks. This is because, 1, the constant and coefficients varied from year to year. 2, analysts' forecasts were not accurate. 3, the equations exclude important firm and firm-specific factors. Please continue reading to page 453.